Among the numerous high-flying growth stocks that have fallen significantly from all-time highs in recent months, Rent the Runway and its subscription business that allows users to rent designer apparel sticks out like a sore thumb in a sea of dubious business models. So as we approach the 6-month mark since its IPO back in October of 2021, I figured it might be time to revisit the fledgling business and see whether its time in the public markets has brought about some much-needed business discipline. Rent the Runway was founded in 2009 by Jennifer Hyman and Jenny Fleiss after meeting one another while completing their MBA at Harvard Business School. The idea for the company was intended to address many women's desires to wear designer clothes without shelling out the thousands of dollars required to purchase them. One only has to skim through the websites of fashion houses like Gucci, Louis Vuitton, and Fendi to see that their high price tags are just simply out of reach for the typical consumer. And the founders knew that even if someone were to save up and splurge on one of these high-priced pieces like a gown or jacket, it's unlikely that the consumer would wear it on a monthly or even yearly basis. In most cases, they'd bring it out for that one special occasion every couple of years, only to put it back in the closet where it will collect dust until they pull it out in a few years' time. This obviously makes spending the $2,000, $3,000, or even $4,000 required to purchase one of these designer clothing items pretty impractical. So in response, the two founders launched Rent the Runway as an e-commerce platform that allows women to rent designer clothing for a fraction of what it would cost to buy the items outright. The company's business model, which they call a woman's closet in the cloud, is built on 3 revenue streams. First is its bread and butter subscription service, where for a monthly fee ranging from $69 to $149, users can select a set number of clothing items from the website's catalog of designer clothing that they want to rent. And after selecting their items online, Rent the Runway ships the items to the user overnight. And when the customer is ready to return it, they just send it back to one of 3 fulfillment centers in the US, where the clothing item gets dry cleaned before being put back into the company's catalog, ready for the next user who wants to rent it. The company's second revenue stream is a rental service for non-subscribers who just want a one-off rental item without the commitment of monthly rental fees. And the company's third revenue stream comes from resale, where users can actually buy the clothing that they initially received as a rental if they so choose. The company's value proposition is a win-win between consumers and producers of the clothing. From the consumer's perspective, they get access to designer clothing at a fraction of the cost without the need to store and maintain it when they aren't wearing it. And from the fashion house's perspective, who manufacture the clothing, they get to expand their top line by gaining access to a desirable demographic of up-and-coming millennials who likely wouldn't have been direct consumers of their product anyways. This way, Rent the Runway acts as a sort of intermediary between the two, hoping to squeeze out some small commission every time its users rent out a new piece of clothing. And that business model translated to serious traction with customers, who seemed to love the idea, with Rent the Runway reaching 145,000 subscribers in 2019, generating $256.9 million in revenue. And with those kind of numbers, venture capitalists wanted in. So by 2019, the company officially hit unicorn status, after it raised $125 million in its Series F, led by Bain Capital Ventures and Franklin Templeton Investments, bringing its total equity raise to $337 million. But the pandemic brought about serious troubles for Rent the Runway and its business model. With consumers no longer going outside as much as they were before, subscribers began canceling their memberships in drones, with the active subscriber count falling about 60% from 147,000 to just around 55,000 subscribers. But despite only a slight rebound in subscribers during 2020 and 2021, Rent the Runway and its balance sheet, stuffed with money from Silicon venture capitalists, were beginning to get significant pressure from investors to go public. So in October of 2021, Rent the Runway filed for its IPO, releasing its S-1 to the public. Now, an S-1 filing typically provides public market investors who are considering investing in the newly public company a glance under the company's hood to see the financial metrics and understand the business model of the company. And the public market did not like what it saw when it looked under the hood of Rent the Runway. The first major red flag was its customer acquisition costs. The S-1 boasted that 88% of its customers were acquired organically, meaning that the firm didn't pay any marketing or incur any promotional expense to have these users sign up. Now, this sounds pretty impressive until you hear that their overall customer acquisition cost was $55. So if we are to believe their previous claim that 88% of their customers were acquired organically, which implies a customer acquisition cost of $0 for those 88%, that means for the remaining 12%, Rent the Runway pays $458 to acquire an incremental customer inorganically, which is exceptionally high. So either their claim that 88% of customers are acquired organically is false, or they're dramatically overspending when trying to acquire new customers. And this high customer acquisition cost is particularly concerning because Rent the Runway is hardly a startup anymore. So it's more than likely that the majority of customers who would have already organically joined the service have already done so. So in order for the company to continue growing, they're going to have to acquire customers inorganically, which means going forward, they can expect to pay that $458 for each incremental customer. To put this into perspective, let's consider the lifetime value of a customer, or LTV, which is a metric to describe the total amount of money a customer is going to spend with a business over its entire lifetime. Generally, a good rule of thumb is that companies should want a 3-to-1 ratio between LTV and CAC. This means that for every $1 they pay to acquire a new customer, they should be receiving $3 in lifetime value from that customer. So if we apply this rule of thumb to Rent the Runway's CAC of around $450 going forward, an LTV of about $1,350 is needed to justify this ratio. And if we assume that most customers subscribe to the regular plan, which costs $94 per month, that means that customers have to remain subscribers for 14 months at a minimum in order to justify this 3-to-1 ratio. But if we look at the company's churn rate, reaching that 14th month mark doesn't look too likely. Currently, Rent the Runway can expect to retain 60% of its subscribers after the first month on its subscription plan. But once we move out to 4 months past its first purchase, that retention falls to 40%, and by 11 months, it drops to 30%. And that's only among subscribers. Non-subscribers have a retention rate of about 10%, which drops to 5% 11 months out. So based on this, it's pretty unlikely that the business can rely on its customers having an LTV that justifies an acquisition cost of $450, since so few of the customers stick around for long enough. Another red flag of Rent the Runway's business model is its use of creative accounting tricks. Like all assets that a business uses to make money, assets have a limited lifespan. Delivery trucks can only drive for so many miles before they need to be replaced. The same way a computer or any other machine can only operate for so long before it breaks down or just becomes too outdated for the modern needs of the business. And depreciation is how businesses reflect this natural lifespan of assets on their balance sheet. But Rent the Runway takes this to a whole new level. Now, as we know, Rent the Runway's business model requires buying an article of clothing from a fashion house, which they turn around and rent to its consumers. Essentially, if they buy a piece of clothing for $1,000, they want to make sure that they can rent it out enough times to make a multiple on that cost of $1,000 to justify that upfront cost and make some additional profit on top. But the company's inventory of clothing can't last forever. Clothing can become damaged after it's worn by the 5th or even 6th consumer. And on top of that, fashion preferences change over time, so what the company may have bought last year might not be so popular with customers next year. So just like any other asset, the value of Rent the Runway's inventory depreciates over time. According to its S-1 filing, Rent the Runway assumes that its apparel inventory has a useful life of 3 years and a salvage value of 20%, which means that after 3 years, inventory could theoretically be sold for 20% of its original purchase price. So imagine Rent the Runway bought a dress for $1,000. That means that for the next 3 years, the item would depreciate by $270 every year. And after those 3 years, the item would sit on Rent the Runway's books at a salvage value of $200. And although there would be no more future depreciation expenses for the dress after year 3, it can still be rented out to the customer. But product depreciation should be a material expense for Rent the Runway. But its management would prefer investors to think otherwise, because they've added this concept to the gross profit line of the company's income statement, where they report something called gross profit excluding product depreciation. But this just doesn't make any sense because the company is essentially trying to say that it's removing the primary cost of goods sold, which in their case is the cost of the clothes that they rent, from their cost of goods sold. But if we take a look at the company's gross margins, you'll see pretty quickly why this financial engineering was needed in order to prop up the company's IPO. Because of this novel invention of gross profit excluding product depreciation, Rent the Runway was able to claim that its gross margin was 51%, which is definitely on the higher end for most retailers and paints a pretty picture of the company's gross profits. However, if we don't listen to Rent the Runway's management team and choose to include product depreciation, gross margins fall to 27%, and the true adjusted EBITDA doesn't paint a pretty picture. In fact, the adjusted EBITDA suggests that Rent the Runway hasn't actually made money since spring of 2019. So ultimately, despite its ambitions to be customers' closet in the cloud, Rent the Runway deals in physical clothing that must be physically worn. An essential cost to such a closet, therefore, is depreciation. Assets that physically move across the country between subscribers' houses and experience physical wear and tear. So the fact that Rent the Runway attempted to misrepresent its true profitability and was dramatically overpaying for customer acquisition was seemingly laughed at by most public market investors when the stock debuted on the New York Stock Exchange in October of 2021. On the first day of trading, the company's reference price was $20 per share, implying a valuation of $1.7 billion for the entire company. But since then, the stock has fallen about 70%, wiping out around $1.2 billion of shareholder value. But if we look out into the future, it's still tough to make a case for Rent the Runway's business, even at what seems like a really low valuation. But if we take a look at Rent the Runway's enterprise value per subscriber, it's tough to argue that the business is undervalued. Currently, Rent the Runway's enterprise value per subscriber stands at about $2,600. But if we benchmark that against comparable businesses that also have a subscription model, it's pretty clear that the company is still wildly overvalued. Companies like BarkBox, Hims, HelloFresh, and Blue Apron all come in at valuations per subscriber dramatically lower than Rent the Runway. But with that said, let me know in the comments down below what you guys think about Rent the Runway's business model. Do you think it's going out of business? Or do you think that some other company might swoop in and acquire Rent the Runway if its share price continues to fall? And who do you think that might be? Personally, I could see a company like Amazon with its impressive logistic capabilities acquiring the business if it gets cheap enough, or maybe even LVMH, who could use the business as a way to push down market and capture new customers.